Can you make sure that we do get a copy when you do?
I'll talk to Christina.
Okay.
Hey, Craig.
How are you? We're about to go live here.
Let me know when we're live. Welcome to Manufacturing Talk Radio. This is a live broadcast. I'm Tim Grady, and I'm here with Lou Weiss. Lou is the sponsor for Manufacturing Talk Radio, for which we are grateful. He's also the president of All Metals and Forge Group, which manufactures open die forgings and seamless rolled rings for industrial machinery, defense, a lot of other industries. And if you can hear that in the background, that's an air raid siren going off. I don't think we're having an air raid, but we are going to have some very exciting and upbeat numbers from Tim Fiore, who joins us, Lou, from the Institute for Supply Management in our Report on Business series. We're always grateful to have Tim with us to talk about his latest report. Tim, thanks for joining us.
Yeah, thanks for having me, guys. Great month again.
So give us the high points on the waves, and then we'll dive into the report and really get into the depth of it, because it's a terrific report.
Right. So we pretty much met expectations, within 10 basis points, give or take. So pretty much this is where the economists thought that we would be, and it's very strong. So halfway through Q4, we're above 61. And seasonality factors do play a part, but not that significant. What I really liked is that it's a very high quality report, meaning that the sub elements that make up that 61, although the number is almost the same as it was in October, the sub elements are different and they're moving in the right direction towards equilibrium. And by that, what I mean is that we've had a demand-driven supply constrained expansion since we climbed out of the COVID issue last year. And the supply base, inventory levels, supplier deliveries have been holding back output, and to the point where the numbers have been pretty significant, well, very significant, supported by price indexes that have been very high. And what I've been looking for and hoping for is that those numbers would ease a little bit, supplier deliveries, maybe somewhat inventories, offset by growth on the production and employment side. The employment number has been the weakest of the 5 sub-indexes. And it should be at this kind of demand level and backlog and low customer inventories, we should be running 62, 63 on the employment level. We haven't gotten anywhere near that. So, but in this month, we had about a 3.5 point shift gain in the consumption / output side, offset by about the same loss on the supplier delivery and inventory side. So I think we're moving it's a higher quality PMI than it was in October. It gives me more assurances that we're going to move into 2022 in a very good way. And there's a lot here. So let's stop there and chat a little bit.
Well, it looks as though, talking about customer inventories, it looks like it really took a major dive at 6.6, which does make for good new orders coming down the pike.
Empty shelves, lots of empty shelves. I mean, you've gone into the grocery stores. I mentioned this before. It's the same thing as you go into the grocery store and you see a whole bunch of empty shelves. So we're near records again. And I think it's the 16th month of below 40, which, proper customer inventory number is probably 46, 48. And we've been well below that. And it probably indicates that it's going to be 2 or 3 months. Once demand eases to, in the 53, 55 level, there's probably 2 to 3 months worth of output just to fill those shelves. And at present, we're not filling the shelves. So we did have a little bit of easing on the backlog side, not significant, 1.7 points. We're still above 60, which I feel real good about. So between the two of those, we've got, even if demand phased out and wound down at the end of Q1, Q2, there's still 3-4 months worth of heavy output here to burn off the backlog and fill the shelves.
Well, we at All Metals and Forge Group experienced over the last 2-3 months a significant increase in our sales and in our backlog. And I love seeing backlog at the numbers that they're in now, which will take care of the Q1 shipping for 2022. So, we're looking pretty good the way things are right now.
Yeah, I mean, that's a sleep at night number, correct? When
Yeah.
backlog is high, it's a sleep at night number. Makes you feel
Absolutely.
good. It gives you confidence that you're going to have money to pay the payroll and everything. So in the month of October, we saw a softening on the demand side. That was the first softening that we've really seen in quite some time. And my analysis indicated that what's probably happening here is there's a little bit of a pause. Lead times are near records. I think modern record on CapEx in the month of November. We're still at record levels on raw material. Prices were still extremely high, and business plans were being approved and solidified for 2022. So I think the supply community kind of did a pause to try to come up with a strategy for, okay, what are these lead times? What are the price levels? Do I really believe that these price levels are going to be this high at the point in time that stuff gets delivered to me? Do I want to really take that risk? And I think we saw that pause in October. But now that things are approved, people are filling up their order book, and we're off and running.
One thing I'd like to point out for this December 1st is that it looks like December, which is not typically a terrific booking month for raw materials, is that it looks like it's going to be a terrific month for raw materials, because we're already at the gate, and a couple of horses and ponies have already started jumping through and ready to take off. They're trying to spend all that budget money before the end of the month. So that's a lot of what we're hearing from manufacturers, that they got to get rid of money.
Yeah, I think that's true. I think the 2021 is pretty much behind us now. Really, what manufacturing people are managing to most likely at this point is cash. So, they're probably looking very closely at the amount of manufacturing inventory, finished goods, work in process, raw material that they have. They now have a cash flow plan for 2022 approved. So I don't think it's really so much output focus for them for December.
Right.
And I think people want to get off to a good start in 2022, because that's going to be a different performance period.
Loving it.
Tim, let's talk about inputs and outputs. That's a area of the report that you kind of reorganize. It makes a great deal of sense.
Yeah, I've got my slides. You guys want me to show the slides?
Sure, that'd be terrific.
All right, hold on. Let's see if I can get these up. All right, tell me when they come through.
You're there.
All right, okay. So here's the what we call the speedometer. Let me, so I can see the right-hand side. It does say November on the right-hand side? Yes, it does. Okay, good. So, for your listeners and watchers and readers, we're in the 6th manufacturing expansion cycle since 2000. And let me get my pointer up here. So we had the China super cycle way back here. Then we had the subprime mortgage cycle that bumped it back up. We had the climb out from the recession. We had the cycle that didn't really enhance employment wages. And then we had the mid-2016 growth cycle that started with Obama and continued through the Trump administration, juiced by the Tax Cut and Jobs Act, the highest quality expansion cycle that we'd had in the prior 20 years. And now we're into this post-COVID expansion cycle. So we're running well over 60 here. You can see we hit a record. I think this is probably back in the spring. And we're still north of 60, which is super good. You can see in that last high quality expansion cycle, there's only maybe 5 or 6 points here that we're over 60. We've easily achieved that here. So, really strong performance. And for your listeners, again, if you look at the averages here, they run about 35 months, from 50 to 50, from the sign of an expansion to going back into contraction. And we're only 18 months into this. Now, this is an odd expansion cycle, just like the seasonal factors are being challenged with this. As Lou mentioned, December is generally a wind down month, close it out, catch your cash and move on. But we still have a lot of people trying to move product through. And this whole thing with the Delta variant and how it sagged some things, we didn't really see it in the PMI, but you heard it across the economy where things kind of slowed down and sped up. The whole seasonality factor now is going to be a real challenge, I think, for the for the statisticians to kind of figure it out. But whatever, if you accept the fact that we're going to be living with variants here for the next 3 to 5 years, which I think, common sense kind of says that we probably are, then the seasonal factors are if they're being impacted by the variants, they'll show that in the future too. So this is a really high performance. The walk away from this is we're 17, 18 months into a typical 35-month cycle. We got another year and a half to go, which gets us into 2023. This is the. Oh, go ahead.
I heard one of the doctors at Johns Hopkins who said, with regards to the COVID, is that we may wind up going through the whole Greek alphabet. So that could go on for a while.
Almost like a bad hurricane season.
Yes.
Yeah. I don't know that I doubt that. And then, the biggest risk to manufacturing really is, we've been saying from the beginning of this, we talked about this back in June of 2020, that the biggest risk is really the foreign supply chain. At that time, I think we were mostly concerned about Mexico, and look at what the foreign supply chain has done to us since then. And I mean, Malaysia is really the best recent example of that, where it took the whole chip industry down for 2 to 3 months because of the packaging activity that they do over there, and how seriously of an impact that had on all kinds of different product. I mean, the transportation equipment sector is our weakest sector of the big six. It's still expanding, but pretty weakly, and that's our number 3 business sector. I mean, it's dragging us down, it's dragging us back, and it's primarily, people want cars, tons of people want cars, they just can't get them. So if we could really free up transportation equipment, you'd see this PMI perform even better, because it's actually holding us back, unfortunately. But okay, so let's talk about the inputs outputs. Let me get this out of the way so I can. Okay, good. All right. So hey, look, the right hand side kind of says it all. We had 10-to-1 positive comments to not so positive. That's a very good number, up from 4.5-to-1. So the optimism in November actually improved compared to October. But in any event, both of them were very optimistic. I mean, even this one, almost 5 people to 1, feeling really good about demand in the future. That's what this sentiment category tries to capture. We had an 18-to-1 hire to force manage ratio. That is, we had 18 companies looking to hire for every one that was trying to manage headcount through freezes, attritions, or layoffs. So that's really strong. 22-to-1, 18-to-1, same thing. So still a bunch of people trying to hire. My general comments indicate under my employment area, 51% of them said that they were having difficulty. In the month of October, 31%, but September 47%. So we're still having trouble. But I think the more important thing here, jump down to this, 7% noted that hiring activity was easier in November compared to October. In October, 5% said October was better than September. In September, 3% said that September was better than August, and 0% said August was better than July. So there's a clear mark there. I mean, it's not big differentiating, but it's a clear path towards something that indicates that people are having a little bit of an easier time hiring people. Now, we also have the turnover issue, driven primarily by backfilling, driven by the workers' chase for increased pay in the areas where they live in. So 32% of the comments noted high levels of turnover. 29 points of that 32 were really backfills, which, okay, you need to hire 2 people to meet the demand, and every time you hire the 2, you got 1 person who quits on you. So you got this never-ending kind of cycle that's very difficult. But the positive thing in this is that we did see a decrease in retirements. So retirements have become a noteworthy, trackable event in my employment comments back in the July timeframe. 4% of the comments talked about either retiring at the proper time or early retirements. But that's nothing that you would expect to see somebody talk about. So these are kind of like unplanned events. 6% in August, 8% in September, and we're now down to 3% in November. So I think that whole wave of people wanting to get out, it might regenerate again if this Omicron kind of takes off. That almost follows the transition of the Delta variant, that people decide I'm done. I'm not going to take the risk. We might see that number go up again in first quarter. Too early to tell. But I think For the month of November, though, it's positive that we don't have as many unplanned retirements, because you guys know that when that happens, it's painful because you lose a lot of knowledge. And I don't care how well you do and write down work instructions, the tribal knowledge element is kind of overriding. So, and then, as I noted here, we pretty much met estimate. 60.3 was the journal's estimate. We came in at 61.1. All right, so here's the three splits: demand, inputs, and consumption. As I've said many times on the call here, the consumption is really the result of either a need, demand, or an input, or both. So, and as I said at the beginning, we've been really driven. The PMI has been not only driven by the new order number, which goes into the PMI, it's been very high, but we've had really high supplier delivery numbers. You can see back in October 75.6. And in this case, we've had manufacturing inventories get to a 38-year record last month of 57. So 56.8, 57, I mean, it's about the same. So we're really at record manufacturing inventories, which consists of raw material, which is probably the biggest piece. We've got a lot of companies taking more pieces, more quantity of pieces than they normally would, because they don't want to have to go chase it again. But they're held up because they don't have the right piece to finish the product. You've got growing work in process accounts, because if you want to absorb overhead, you got to manufacture something. And a lot of companies are making a bunch of stuff, putting it aside and waiting for that one piece to show up. And then I think the best example here is what's happening in automotive, where you've got factories intermittently shutting down. And when they do that, they won't let their suppliers ship. So you've got a growth in finished goods inventory too. So we're at a 38-year record here in terms of raw material manufacturing inventories. But what's been sleeping here is really this consumption output number. Good performance here in production, 61.5. With this kind of backlog, empty customer inventory, i.e. shelves empty, we should be new order levels running above 60. This production number should be 65, 66, maybe even higher. But the biggest sub-index that's been dragging down the PMI has been the employment number. We made some progress in the month of November, 1.3 point gain, which is good. And it coincides with the notes I just provided, 7% commenting about it being a little bit easier compared to 5% in October and so on. So we had a shift here. You can see over here, we had supplier deliveries was 3.4 points down. Manufacturing 0.2 down. So that's 3.6 points down. That would have been negative to the PMI. But it was really offset by the gain here in consumption, 2.2 and 1.3. So 3.5 point gain. So like I said, and this is a much higher quality. It's higher quality because the supplier delivery number is easing a little bit, and the production and employment numbers are gaining in strength, all supported by the fact that demand is still exceptionally good and very comforting, so that Lou can sleep very easily knowing that he's got the backlog.
Love the backlog.
Jim, I'm just curious about customer inventories at 25.1. Is part of that being driven by ships offshore, goods not moving by trucks? They really just can't get what they need?
Well, yeah, I'm sure that's contributing, no doubt about it. I don't think it's so much that, I think demand is strong. Demand by itself in a normal supply chain would probably, with the strength of the demand that we have right now, would probably be driving that customer inventory level down. Think 40, 42, maybe 38. But at the level that we're sitting at now, 25.1, I mean, that's a combination of demand being really hot and the supply community not being able to deliver. That's kind of the result of it, is that there's empty shelves.
The supply chain issue, which I brought up last month, a website called marinetraffic.com showed that there was roughly 100,000 ships out in the middle of all the collective oceans. And I said at that time that if you looked at the Suez Canal, you can't see any water. And it's amazing anything can get through. Last night on late night news, they reported that there is a ship stuck in the middle of the Suez Canal that has now jammed the canal where nothing is moving. Again,
It's happening again.
Yep.
Yeah, we had that last summer too, didn't we?
Yes, yes.
Is this a big ship? Must be if it's stuck in the canal.
Well, the whole canal was filled, And now the ship is sideways and is blocking everything.
Oh, geez, here we go again. I would have thought they would have solved that problem.
Well,
Probably too many tugs to pull too many boats, and they can't protect the ones that are there. Yeah, not enough tugs.
Yeah.
Need more tugs. It's probably in the backlog.
so take a look at marinetraffic.com. You'll see how bad supply chain really is as compared to the way they talk about it on mainstream news.
Yeah, that's good. Let's chat about that. I've been saying that the transportation sector is normally an enabler to resolve issues that crop up at the supply base or at some level of the supply base. It's now become a hindrance because it's not only is it taking a lot longer, it's absolutely not reliable. And the world has never been, especially in the ocean freight area, that it has never been an area that is very transparent. So when you talk to a lot of CEOs, they say the same thing. The biggest problem here is we have no visibility. We can't really see what's going on. We don't know. So, you tell a customer, I'm not going to ship it next week. And then the stuff shows up so that you can convert it and ship it. And they went, well, didn't you know that? Well, no, I can't tell because there's no transparency here. So, I've been saying that when the transportation sector eases, then we know we're getting to a much better level of equilibrium. We're not there yet. So in the supplier delivery area, which is where you would expect to see a lot of comments around transportation, 55% of the comments were around transportation, 47% in October, 37% in September. So it's continuing to get worse. But I think November was the peak. I really think it was from an ocean freight standpoint, not road, ocean freight, because it was a peak of the holiday season, October, November. But we're now into the pre-Lunar New Year surge that will continue now until the middle of February. And then we're going to have a 3-week break or so to kind of catch up on it all. So on the ocean freight side, supplier delivery comments, month of October, 27% commenting about ocean freight problems. Month of November, 21%. So maybe a little bit of easing there. If you go back to June, it's 13%. So, clearly a pattern here. But the thing that I'm probably most concerned about now, been expecting that the port issue will free up by the end of the first half. I think I said that in October, maybe in September. It's now, I didn't quite realize this, but apparently there's a longshoreman contract that expires on July 1st. So,
of course there is.
Yeah. And how many times have we lived through longshoreman ocean container negotiations that never really end well? Yeah. And so now you got the longshoreman sitting in a pretty powerful position, trying to get concessions out before this thing kind of eases. So, you could easily argue, and I don't know, in the last 20 years, there's probably been 2 or 3 strikes on the West Coast. They're all in one bargaining group, all the West Coast ports. So it's going to be interesting to watch that. I'm still hopeful that that doesn't become a factor in throughput. I'm still hopeful that end of February, March, we're going to see some of this backlog burn down so that we can get back to a normal flow of stuff. And I'm particularly hopeful because I ordered a new desk and it's going to come in from overseas. It's probably stuck in the water somewhere.
So we all have to brush up on the Taft-Hartley Act that prevents unions from striking when it negatively affects our economy, our security, and so on and so forth.
So that was used in the last 20 years. I recall that was used by or maybe it was Nixon or something. I remember that the president issued a decree that said to get back to work.
That's right. That's right. And I think it was the ports.
It was ports. Yes, it was. It was LA. Well, it's the whole West Coast because they're one big bargaining group. But hopefully management will do the right thing too. I mean, hey, these things aren't the cause of one side. It's usually just both sides that disagree and can't come to a bargain. That's what bargaining is about, right?
Right.
Well, Tim, if you'll get back to your regular screen so that we can see you as you chat with our listeners, I just want you to give us kind of a summary of what it looks like for 2022. I realize it is excellent at the moment, and it looks like we're at halfway through an expansion cycle. And I don't know what that 61 number translates to in terms of GDP, but it's got to be good.
Yeah. So Right. I think we've had a fantastic year. I think I was talking with someone earlier that it's really just the automotive sector that's held us back. And I think that, manufacturing has been extremely resilient here. And hats off to every supply management operations person out there fighting through these battles every day. There is a piece of fatigue, and there's probably an element of numbness because you go to work every day, you expect, oh, well, I'm not going to ship the product until you agree to a higher price. Or sorry, I promise you, you're going to get 10 of those tomorrow. I don't even know when you're going to get them. And this is happening every day. So, I think that we can stick with it when we will stick with it. There's no other choice. Supply management people like what they do. But this has been going on for a long time now. There's definitely a bit of fatigue and numbness happening, but I'm hoping that things will kind of free up, primarily the chip issue, sometime in the first half of next year. There's a lot of talk about whether it'll carry through to 2023. Like I've been saying, I think we're not going to know the full story about 2022 until we get to February, March of next year, and we're into the performance period, and people are probably going to be a little bit more optimistic than, it's hard to be optimistic today when every day you're having problems from the standpoint of revenue. So, the other thing is, this prices index has been very interesting because what it really signifies is that you've been able to push price through all the way up the supply chain. Our panel consists of, fundamental raw material companies all the way to people who make finished goods. So if you get 65% of the panelists saying that they're accepting higher prices, that means you're pushing price increases through. As we've been talking now for quite some time, we thought the Q3 would be a good, profitable performance period, and it was. And we were pretty optimistic that Q4 would be the same, meaning that everybody's taking the price pressure, passing it all the way through. And I think that'll be the case in Q4. And I think it will be in Q1 too, as long as demand stays where it is. You heard Chairman Powell yesterday about eliminating the word transitory. I've been asked about that several times today. And the only example I really have is, well, look, the price of plastics are coming down. Will they get back to where they were? We'll see. With the price of natural gas being $4.50 right now, down from $5.50, that's a good thing, but it needs to get back to $2.50 to $3 to get back to the plastics cost and chemicals cost that we were experiencing pre-pandemic. The steel market really well. We're down to $17.50. It's not budging much. We capped out at 2,000, and it wouldn't break that barrier, but it's stuck now at 1,750 to 1,800 for several weeks. We'll see where that goes. I just don't, at this point, without a major economic event, which I do not see or predict in the next 2 years, I don't see how you get back to 650 a short ton of hot rolled steel.
According to the Federal Reserve, I wouldn't be surprised if you start seeing interest rates go up.
I think that put a shock through the system yesterday, right? I know. Yeah. And there's more and more talk about it. We'll see. I mean, the easing has started. I tracked the asset purchases, and I didn't see nothing significant. I'm not sure if they've actually started to ease a bit, but they were supposed to by the end of November. The number I have is November 18th, and the balance sheet actually increased. So I think the easing kind of means that they stop buying, or they slow down the buying. They slow it down, and so we'll see. I mean, that's a shiver. That's a shiver with all that money out there. I'm more concerned about the U.S. economy with a $28 trillion deficit.
It'll never be paid.
Never be. Not in our lifetime.
It'll never be paid.
Well, we can only hope now it doesn't go up anymore. I mean,
well, it depends on who's in power.
I think they all decided that it doesn't really. I'm only here for 8 years, so I might as well drive the deficit up. And that seems to be the thing. Give everybody, hand this money out. Hand the money out, whether it be to industry or whether it be to people. Hand it out, because I'm going to be gone in 8 years.
That's right. Print it and give it away.
Yeah, that's exactly what's happening.
I guess that's our full employment goal, right? Just hand the money out and everybody continues to work until it turns into the Turkish lira.
Yeah. Well, Tim, thank you for joining us. We appreciate and want our listeners to know that this information is at ismworld.org. That's the website you can go to. And while you're surfing around, visit us at jacketmediaco.com where you can find the other shows that you see behind Lou. Tim, again, thanks for being on Manufacturing Talk Radio.
You bet, guys. Thanks a lot. Talk to you next year. No, we're going to see each other. No. Yeah, I got it. Going to do the forecast.
We actually have a great show coming up with Tim and Anthony Nieves on December 13th. That is going to be their semi-annual forecast update. Tons of great information. Don't miss that episode.
Yeah, great. It's a great for it. We're going to look at what happened in 21, and we're going to, more importantly, predict what's going to happen in 22. Thanks, everybody.
Take care now. Okay, Tim, what do we got coming up?
Great report. I'm looking forward to the semi-annual forecast from the ISM. This has been a vastly improved year over 2020. We'll see what 2022 begins to look like.
Absolutely. And if backlog has anything to do with it, I know that Q1 is going to be very good. So I'm all excited about that. I may even get myself a brighter yellow jacket.
Yeah, there you go. And for those of you listening to the show, get your orders in at allmetalsandforgegroup.com. You heard all the supply chain issues. There are bumps in the road, so order early, order often.
Okay, that looks like a wrap. Tim, we'll talk in about 2 weeks.
You got it. Thanks, Lou.
All right, take care. Take care, everyone. Thank you for joining us.